Well, good morning, everyone. It's actually I'm thinking December. That just to show you where my mind's at. It's January 31st. It's the last day of the month, and all I'm gonna say is, where in the world did January go? The weather has changed, definitely, no question about that. But I'm telling you, I'm ready for the summer again. All right. So yesterday we had GDP jobless claims. Both numbers were on par with estimates. Earnings, tech has been impressing. Numbers have been slightly better than expected. This is positive for the stock market. Today, in less than half an hour, we got personal income. We got the employment cost index, and later in the day, we have consumer sentiment. Consumer sentiment's not considered a huge report, but it's very important because it gives us a gauge of how retail traders are looking at the market. It's telling us how consumers are looking at the market. It's giving us their level of fear and greed, which is really important because consumers make up 70 to 75% of this nice little report here called the GDP, which is responsible for the most data of the quarter. So consumer sentiment on its own is not a huge report, but it gives us some clues. It's like being Sherlock Holmes and looking for breadcrumbs. Now, let's talk about Fed. This is important. Fed said something important. They had a meeting right here on Wednesday. I'm just kind of giving you a little week back review. They had a little meeting here, and they said something really important. They said they're not going to raise rates. They're not going to lower rates. They're going to kind of wait to see how things go. But that wasn't the important part. I'm not sure if you guys know or not, but the Fed has been putting money back into the market, much how they did in 2008. You might have remembered being called quantitative easing. Well, as of last year, I think it started the quarter before last, or about 4 months ago. Don't quote me on the time, but the Fed has put about $60 billion into the bond market. The purpose of this is to bring liquidity into the market, to make bonds go higher and keep interest rates low, which has been working. Now, when they did this in 2008, they had to do it. They didn't have a choice. Yellen and Obama looked at each other. They said, if we don't do this, we're going to have the worst recession since the 1920s. And fortunately, they did something about it, and it twisted the market. It created an artificial bubble in the market. But the thing about it is this quantitative easing, it's starting up again. And it was very positive. To give you some idea, the global stock market in 2008 was worth about 68 to 70 trillion dollars. Excuse me, it's now worth 68 to 70 trillion dollars. Back in 2008, the global market was worth 34 trillion dollars. That's how much the US market is worth right now. So can you imagine 2008, we're talking 12 years ago, global market worth a little over $30 trillion. Now just the US market is worth $34 trillion, and the global market's worth about 68 to 70 trillion dollars. Don't quote me in the exact figure, but I don't think I'm off by more than 1 trillion. It's a lot of money, but when you're talking 70 trillion, 34 trillion, you get the point. Bottom line is, this is why the bond market has been rallying, because it looks like they're going to stop. They're going to put an end to this quantitative easing in April. So watch for a little more upside, but honestly, I think the bond market's going to pull back. We're already overbought. The long-term trend, if you could see here, the long-term trend has been kind of moving down. Don't think it's going to move back up all the way to the top. We have to see what will happen with the stock market. If the stock market will stay bullish, the bond market will revert lower and fill this little gap here and can come back down to the gap area right here and back into the trading range. So I believe this was the peak of the bond market, and unless we see something extraordinarily unexpected, that's probably a good way to say it, that'll probably end up being the peak for the long-term view, and the market will start coming lower. And this is probably just a second medium-term top. This is a weekly chart, so this is giving us a lot of fundamental data here. Each of these bars, is a week. So again, I believe bond market's going to come down, and I believe stocks are going to rally again. Although we've got a lot of factors on the table. The biggest factor right now that's impacting global economy is this coronavirus. As of right now, 213 people have been killed. 9,700 have the disease. Yesterday, the number was in the 7,000s. Now it's in the 9,000s. Honestly, it's hard to, it's a moving target. And because it's a moving target, it's going to impact the stock market quite a bit. Now, Eurozone also had the worst growth since 2013. They grew 1.26%. Not a really good number, the worst number. So expect some downside based on that. Expect the stock market, the US stock market, to come down. Volatility is expanding, and we're getting towards the 50-day moving average. And I told anyone who would listen to me over the last month that momentum levels are going through the roof and markets are going to come down. Let me just review that with you again. I hate to say I told you so, but I did. What I did was this. I showed you the S&P. I showed you the percentage of stocks trading above the 200-day average. I went to 5 years. I changed this to line charts, and boom, we had the highest momentum levels that we saw in 5 years, and I warned you that we're going lower. And I still believe we're going to go lower. I believe we're going to hit about 50% of stocks trading above the 200-day moving average. So as I was saying, momentum levels were through the roof. Momentum levels went all the way up. Now it's coming down, and it looks like we're going to go lower. There's a good chance we'll come to the 50-day line, but the odds are we're going to come right here, which would put the S&P 500, let me show you this, right at the 50-day average, or probably right around here. Let me show you the 200-day line here so you could see what I'm talking about. The most probable expectation for the stock market is to hit right here and then come up, maybe a little higher, but do expect to see 300, 275. It's not unexpected at all, not even close. Now, I've got something for you today. It's Friday, and you know what Friday is? I give you my top 3 stocks. So, first stock, it's a utility. Utility is a defensive company. I like this stock, and it's one of my top 3 stocks. Here, you could see them here: PCG, Apple, FTNT. And then you got AMD, LRCX, DVA, and Qorvo. Remember Qorvo? Still in the top 10. It's been, what, about 2 months now? This thing is powerful, folks. PCG, Apple, FTNT. Let's look at each one. Trading higher, not near all-time highs, making its way higher. Looks like it's just bottoming out and coming back up. Could be a good deal. Relative strength right now on the stock is very, very strong. Look at this move. That's daily. I showed you weekly. This is daily now. Actually, this is intraday. Sorry. This is daily. Look at this trend. That's a nice trend. Nice, and volatility is not increasing. And what I like the most about it, it's a defensive sector. Second stock, you all know this name. It's Apple. Apple made all-time highs, had better than expected earnings and revenue. Now it's coming off a little bit. Again, expect Apple has huge market share, so expect Apple to have more influence on the stock market, especially the tech, in the next few days, especially in line of the virus, the stock market coming lower, and the Fed telling us they're going to pull money out of the bond market, or not keep putting money into the bond market, and the worst numbers since 2013 in Europe. So last stock, FTNT, Fortinet, again, very bullish stock. I like the fact that volatility is not increasing, and I like the fact that it's basing here. I would wait to see it take out the all-time high around the 120, but I do like the stock. Apple, I think, is a little overdone right now, especially with earnings that already came out. But I do like FTNT, and I do like PCG. Folks, I hope that helps. You have a wonderful weekend, and I'll be back Monday with all new market analysis for you. Have a great weekend. And if you guys enjoyed this video, send me an email. I haven't heard from you in a long time. support@marketgeeks.com. That's my personal email. Send me an email. Let me know if you like these videos. Let me know if you're getting something out of it. I want to hear from you, especially over the weekend. I may even post some of your responses here. Talk soon.